This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Today on the show, I have Tushar Chande, and he is the co-founder, head of research at Rho Asset Management in Switzerland. Tushar has had a long and distinguished career in technical analysis and is a trend-following trader. So I think we're going to have a really good conversation. Definitely a perspective especially on how to look at markets when you're a trend-following trader that I think will really resonate with a lot of you out there. So anyways, enjoy. Hey, how are you?
Hey, Mike, how are you?
Not too bad. So where am I reaching you today?
Right now I'm in Des Moines, Iowa.
Oh, okay. Well, that's far less interesting than Switzerland.
Yeah, I know. Well, usually I'm in Switzerland, but holidays, so we're just spending some time here.
Gotcha.
How have you been?
Not too bad. How are you?
Excellent. You recovering from the snowfall you had, or
yeah.
Are you in New York somewhere?
No, I'm in Virginia, right outside D.C.
Oh, okay. So you guys did get snow.
Yeah, we got a little bit. Not too bad. It was.
Not too bad.
It was. I mean, it's already gone. It was the day after Christmas, and boom. So I'm just going to jump right in.
Okay, go ahead.
So today on the show, I have Tushar Chande, and we are talking all kinds of stuff. I know trend following is near and dear to him. He is with a firm called Rho Asset Management. He's the co-founder and the head of research. Tushar, thank you for joining me today.
Well, thank you so much for having me, and a very happy New Year, and welcome to all your many listeners, I'm sure. And hopefully we'll have fun and discuss a few interesting things that they can use as well.
Yeah, hopefully we've got some listeners today. You never know if they're going to show up. You always,
I'm sure they will.
You keep your fingers crossed and you pray that they don't disappear.
Oh, they'll be here. No worries.
So listen, let me jump right in. I've been reading some of your research, and you have been you've got an interesting kind of story analogy that really made me think in the last couple days. And you've done some writing and comparisons and getting people to think about the world of sports. And specifically, what you're doing is you're talking about the consistent element of sports that maybe people don't think about, because I think sometimes people like to think, well, a football game, it's always changing, it's always different. Well, there's a lot of consistent elements to football. There's a lot of consistent elements to tennis, etc. And you make these comparisons in a nice way to the trading environment. And I thought I might let you run from the very beginning and just kind of outline your thought process there for people that...
Okay. I'm a great fan of sports, and I'm particularly a great fan of Formula One as well as American football. And of course, I've been trading for a long time. So it's natural for me to find an analogy between sports and the trading environment. And here's the point I want to make. That when you evaluate your own performance or my performance or the performance of any other manager, it needs a context. You have to understand that the performance has occurred within the context of what the markets were doing. So you cannot evaluate performance in the isolation with the market environment. So this is really about the market environment. And when I was thinking about the market environment, being a sports fan, I naturally converted that into an analogy and tried to think of what does this mean in the context of sports? And here's what it means. The best sportsmen always rely on having a stable environment in order to perform at their best. And when their performance is affected by their environment. So let me give you an example. If you're a Formula One driver, your car is optimized for a dry track. As soon as it starts raining, all bets are off, and the lap times go up dramatically, and the drivers generally, the handling goes bad. If you think of a cricket player plays on a certain kind of pitch. As soon as it rains or there's some other change in conditions, his performance goes away. If you think of a golfer, golfing is also a good analogy. If you think of a major tournament like the Masters, The golf course is fixed. You pretty much know where the trees are and where the bunkers are. And you pretty much know where the hole locations are going to be on which day. So they say that you play golf between the 6 inches between your ears, because what happens if the wind kicks up? Well, the scores kick up as well. So the point here is that if you think of the best athletes, their performance assumes and depends on having a stable and predictable environment for their particular sport. As traders, we are exactly the opposite. Our performance or our trading environment is never stable. It's constantly changing, changes in liquidity, volatility, trendiness of the markets, and yet we have to continue to perform at a high world-class level. So think of another analogy. If you won 7 Formula One championships and you're driving a car with 750 horses, can you now turn around and say that you could drive one horse around the Kentucky Derby and win that 7 times? And the answer is no. If you think of somebody that's won 5 Wimbledon championships, and you say, now, can he therefore win 5 basketball championships? The answer is no. So what this means is that each athlete is highly optimized for their particular sport. And even though they are performing at a world-class level in their sport, that doesn't mean they're automatically going to perform at a world-class level in another sport. But as a trader, we have to perform at a world-class level regardless of market conditions. So our job is much more difficult. And just to continue the sports analogy for a moment, in any sport, they have a break. They have a season that goes on for so many weeks or months, and then the pro circuit comes to a halt. The athlete can take a break, and relax and think about something else. As a trader, there's no off season. The markets are marching on day after day after day, and you never get a break. So another way to think of it is that if you're a trend follower, the markets are changing all the time. So when you come to work, you have to bring your golf clubs and your racing saddles and your ski bindings and your cricket bats, and you have to be prepared for all kinds of conditions, and you're expected to perform at a world-class level when really the best athletes have it a lot easier. So that is kind of the analogy I was trying to get at, that the trading environment very much affects your performance, and that's true whether you're an athlete as well.
Well, there's a lot of different elements that are interesting there. I think from a market perspective, if I start to think about, you mentioned, someone who's proficient in one particular sport, that the translation might not be there. But when I look at a trend following trader, there's proficiency across markets. And often these markets have no connection to each other in any way, shape, or form. So to be proficient in trading corn and proficient in trading currency, to be able to do both, have you taken the analogy in your mind to the idea of a particular pro athlete trying to jump from sport to sport? Were you going that far with your analogy? Let's take a step back. What you're talking about implicitly is a discretionary trader versus a systematic trader. Now, if you're a systematic trader, what you say is true, because you can have a single model that is, quote, robust and therefore can be used across a wide range of markets, such as, say, corn or bonds. But if you think of the olden days when there were pit traders, and if you stood in the bond pit and you were really, really good in the bond pit, if you were now forced to trade in the soybean pit, you wouldn't trade nearly as well in the soybean pit, because your whole system was optimized to trade that particular pit versus the bond pit versus the soybean pit. So the analogy really is in terms of systematic trading versus discretionary trading. And certainly on the discretionary side, the analogy still holds that if you're proficient in one market, you may not be as proficient at another market. Well, I tell you what, let me jump back also for the audience, some of them that might not be familiar with you. You've had several books out in the last decade, and you write for Stocks and Commodities, Technical Analysis of Stocks and Commodities, editor there. But why don't you go ahead and give for people some background and say, where was Tushar as a young man? How did you make this? How did you make this jump into becoming this? With a trend following firm and this really nice proficiency in a subject that a lot of people still don't have any clue about. So how did you make this jump? When? How old were you? What was going on? Give me the young man version.
It's been so long since I was young that I've forgotten. So maybe that's the right answer. No, actually, the story is actually fairly interesting. I started off as an engineer. I was born in India. I went to an engineering college called an IIT, or Indian Institute of Technology. That's very, very difficult to get in. So in my particular year, about 100,000 people took this nationwide exam. and only about 1,500 got in. So you can see the funnel was very, very sharp. And then I came to America. I got my Ph.D. at the University of Illinois. And when I was coming to the end of my Ph.D., I was sick of studying. I was sick of doing anything with academics. And I said, I'm going to do completely different. And this was in the late 80s. And, there was a market crash and this and that. So I said, okay, let's start looking at stocks, because that seems like an interesting area. So I started reading about stocks and so forth. And so all the skills I had learned in the research area as an engineer, which meant that I was comfortable with numbers, those skills could be transported and applied to the numbers that represented stocks or commodities. So it's my familiarity with numbers and my ability to visualize and think in numbers quantitatively is the skill that I learned as a part of my academic training, and my ability to think differently and innovatively. And that is really so that's how I sort of got interested, meaning as a rebellion against having been yoked to academic books and studies and so forth. I said, I'm going to do something completely different. And then over time, I did a lot of research. I published the research. And then it was a natural transition to go from doing research to doing my own trading, then managing people's accounts. So as a young person, I think the most important skill I learned was how to internalize numbers, how to understand what the numbers are saying, and being able to reanalyze them or represent them or visualize them in ways that would give me a competitive advantage.
How have you been able to, and this probably goes back to some early training and early understandings, a great number of people, when they get involved in markets, they can't help but look at the dollar signs, and they think about all the money they can make, and they think about the car they could buy, and all these kinds of fun things. Going to the Grand Prix events in Monaco, and they dream of of all these things. How were you able to keep the emotions at bay as you started to get into understanding trading? And obviously you're talking about the engineering background and being comfortable with numbers, but still there's that other side of it, the psychological side that pulls at most people. How are you able to start to manage that early on?
Again, I think it was it was learning by doing. That's the short answer. And the long answer is that it's by a process of trial and terror, not trial and error. Essentially, what happens is that you're going to start somewhere. So I started trading. And then, of course, I encountered many of the problems that you would have as a beginning trader. But I had a slight advantage, and that is that I was never interested in being a discretionary trader. I was always interested in being a systematic trader. And I think that it's actually very difficult to be a systematic trader, because psychologically, that's not what you want to do. Your mind is pushing against it. But if you can learn to be a systematic trader, life becomes dramatically easier, because you can automate the process of risk control, money management, entries, exits, stop placement, and things like that. So for me, it was relatively easy, because I started on the systematic side, which I think made life easier. But of course, I had to go through my own ups and downs, and as I said, I really learned it by a process of trial and terror. Well,
let me dig a little bit further there, because I think for most people, the way that most people come at the markets, there's very little information early on for people to say, well, I want to come at this systematically. So did you have any specific early influences, either other authors, other traders that brought you into the idea that ultimately you could be going a systematic quant route or a systematic trend following route? Were there early influences for you?
The answer is sort of yes and no. I already had a quantitative bias, and so I was more interested in the modeling aspect, because that was my training and background. But early on, I met Stanley Kroll, who was a discretionary trader, by the way. But he had a very systematic methodology of doing it. So if there was any influence, I think and he was a true trader. He came up on the grain pits. He was a big trader in the 70s, and they would be swashbuckling, putting on, thousands and thousands of contracts and whatnot. So I got a chance to interact with a purely discretionary trader who was very systematic in terms of record keeping, in terms of keeping tracks of profits and losses. So I think, as I said, so I was able to look at his approach and learn from it to the extent that I say, these are the problems, and I can already beat this because I know that I want to do it with a systematic approach. So I guess what I learned was that, of course, plenty of books are available. I read everything was available, so I can't say that the influence of some of the books that I read was zero. But on the other hand, I could interact with a real live grain trader, a very swashbuckling personality who used to live on a boat, etc., etc. Quite a storied character. But my takeaway from that was that, gee, I'm much better off if I could be systematic, and that just fit in with my personality. And this is partly a choice, meaning, what is your personality? Are you willing to be disciplined and systematic? And that was just part of my training and background.
Let me jump back to something we were talking about earlier with the analogy to world-class athletes in sports. You've developed something called the Rho Trend Barometer. Obviously, the name of your firm is Rho Asset Management, but maybe you could jump in and run through the idea of what the Rho Trend Barometer is doing and how people can conceptually understand the benefit there.
Okay. Let's go back to the environment that we talked about, right? I mean, if you're a Formula One driver, you want a dry track. If you're a swimmer, you want an Olympic pool with very few waves. If you're a gymnast, you want your balance beam to be a certain width and exactly a certain height above the floor. So which means that there's a way to quantify the playing environment, right? I mean, if you think of Wimbledon, the light is too low, we're going to stop playing. It's raining, we're going to move the roof over the stadium. If you're a football player, we all remember the ice ball games where, the receivers can't hold on to the ball, or the rate of fumbling goes up when it rains, or it's very, very cold. So my approach, the question I had was this: can I quantify the trading environment? Why is this relevant? If you're an individual trader and you're trading really well, it might be not just because of what you're doing, but also because the background environment was extremely favorable. And you might overestimate your own ability to trade, and you might run into trouble when the markets are not so friendly. Conversely, if the markets are unfriendly and you're an individual trader, you could say, I'm terrible at this, I should give up. When actually, if you just persist for a few more months, the trends could turn around and you'd be quite successful because you were doing everything right to begin with. So this ability to quantify the environment is tremendously valuable to you as an individual trader, and to an allocator. If you're a professional in the business, you want to say, okay, what happened? How do I evaluate the performance? What's happening in the background? So now traditionally the approach was you just looked at a benchmark index, like the Barclay Group has the Barclay B Top 50 index, the Top 50 CTA index, or any number of other indexes. Now, what's the problem with an index? The problem with the index is this: that number one, you don't know what the effective portfolio weights are, because you don't know, what all these different managers are doing. And secondly, you don't know what the system strategies are, because there are all kinds of strategies in an index. So my goal was to come up with a simple trend following index that is pure trend following and nothing else, number one. And number two, that equally weighted a fairly large number of markets, but not so many markets that the typical investor could reach them. So for example, if you're a professional, you might trade 100 markets. If you're an individual, you're not going to trade 100 markets. This is way too many for you. So we came up with a group of 44 markets, which represent the major US-based markets and the major foreign markets. And we said, let's build a system or a process that allows us to evaluate the environment. Well, what does that mean? We came up with a process where we could scale every market from 0 to 100. So 0 meant that it was, sorry, let me take a step back. If you think of a market, and if you show a chart to somebody, is this trending? They'd say yes. You give them another market, is it trending? They'd say yes. So if you think of a trend, you can have 5 regions, right? You can have strong up, neutral, medium down, and strong down. So if you could somehow categorize each market in these 5 areas, then you can look at the portfolio and combine the information on all the markets to come up with a single number. And that single number just says, this is the percentage of markets that are trending at any given time. So that number obviously is between, say, 0 and 100 meaning all the markets are trending 100%, and 0% would mean that none of the markets are trending. So this is objective, equally weighted, and pure trend following. So if you are an individual user or an allocator, you could go to our website. That's rhoam.ch. It's .ch because we are based in Switzerland, and it's rhoam.ch. And you can just look at it, and every day there'll be on our landing page, our main page, is a summary that tells you what's the number of markets trending? What is the trend? Is it strong up, medium up? Then gives you the average, some of the average performance or trend strength by sector, and gives you like a 90-day view of the trend strength. So the idea here is that you can ask yourself the question, as a trend follower, should trend followers as a group be doing very well or very poorly or maybe break even? And I cannot tell you how important this is to have a completely unbiased, objective standard that you can get for free just by going out and clicking it, because it removes the ambiguity of what is the environment doing. And once you remove the ambiguity of what the environment is doing, now you can evaluate your own performance or anyone else's performance and say, gee, trend followers trends were working great. There are lots and lots of trends. I expect that you should be up strongly this month. Or there are virtually no trends. How good are you at managing risk? Are you down 1 standard deviation, 2 standard deviations, or what? So this is extremely powerful to be able to say. It's the same thing as saying that if you're in the Olympics, you can measure the height of your apparatus and say that's exactly 5 feet above the ground or whatever. So being able to quantify the environment is super important and super useful, because it eliminates speculation and conjecture about what the markets in general are doing for diversified trend followers.
Well, and you know this as well as I. Every time there's a trend following drawdown, I will receive a certain amount of emails, or you'll start to see the chatter online. The end is near, the strategy is over. And what I like about what you're doing is you're saying, hey, hold on, let's take a step back. Let's think about what this strategy actually does and how it's designed to make money. And it's designed to make money when markets are trending. And I think what is nice about your thought process here is you're saying, hey, hold on. Yes, it's important to what the individual trader does in their system and their strategy, but we also need to think about what the markets are doing, because if the trend following strategy makes money when markets are moving. And so I like the thought process that you're trying to get people to think about there, which is, yes, you can fixate on the manager too, but let's also think about what the markets are doing.
Indeed, because, if you think of any manager or system, there are 2 parts to their success. The first is the system design itself, and the second is the portfolio weights. Why is that relevant? Because ultimately what's happening in their portfolio combined with their portfolio weights and the systems is going to determine their performance. But if you don't know what's happening in the portfolio, you can't evaluate their performance. So I think this is a difficult problem. It's hard to find a unique solution, and there probably isn't a unique solution. But we've done the hard work, we've done the grunt work, we've run this thing for more than 3 years. We're very happy with the way it's working. We can explain about 80% of the variance in the benchmark indexes, which is fantastic. And the basic point here is this, that if you want a single number, you have to just remember 45%. That's the break-even level. If more than 45% of the markets are trending, then the market conditions are favorable and trend followers should make money. If fewer than 45% of the markets are trending, trend followers generally lose money. And around 45% is sort of the break-even level. Now, just think of it for a second. Now, I've given you a single number that helps you answer the question, is the environment friendly or unfriendly? And how friendly is it or how unfriendly is it? So now you can look at your own performance or another manager's performance or your investment returns and say, does this make sense? If the markets are totally unfavorable, you can't expect your manager to be hugely profitable. Conversely, if the markets are extremely friendly, you can't expect your manager to be down a lot. So just being able to have a context that we can all agree on is tremendously valuable to evaluate your own performance as an individual or the performance of a manager.
Well, obviously, in the management world, one of the favorite ways to judge is the Sharpe ratio. Right. And obviously some limitations there, and I can let you go into that. But I think the Sharpe ratio probably played a role in your development of the Rho.
Yes, in fact, the Sharpe ratio was developed by William Sharpe, I think back in the late 50s or so, where he was trying to quantify performance. It's really for an unleveraged investment in a broad basket of stocks. But of course, it's been applied to many, many other things. So mathematically, there was a certain reason to go the way he did. And then people have expanded and applied it to a bunch of other things. And it's in this process of applying it to other things that the weaknesses in the measurements show up. But let's take a step back and say, ultimately, we're looking at monthly performance numbers or daily performance numbers. Yeah. And the numbers are what the numbers are. And we can munch them and crunch them and grind them and come up with all kinds of different numbers, which all mean slightly different things. But to a large extent, they'll be correlated because at the end of the day, they're coming from some underlying data set. So having said that, we look at what we call the monthly return efficiency. And what does this mean? So it's the average monthly return divided by the standard deviation of monthly return. Now, why is this relevant? So think of it as miles per gallon for your car. If you put in 1 gallon of gas, you can go 20 miles or 15 miles or 45 miles. So the denominator is the standard deviation of monthly return, and you can think of it as 1 unit of risk. And you put 1 unit of risk into your manager or your trading program, and the output should be what is a return per unit of risk. So if you take 1 unit of risk, if you have 10% annualized as the standard deviation or 3% as your monthly standard deviation, then how much of that risk is being converted into money in your account? So that's the return efficiency that converts a given amount of risk that you are willing to assume that you've put in the tank into returns that you can put in your bank. So return efficiency, and Rho is the return efficiency. It tells you how efficiently the manager or the system or you as an individual trader are converting the risk that you're willing to absorb into returns that you can bank. So that's sort of our measure. Of course, it can be annualized and this and that, and ultimately it is related to the Sharpe ratio because if you look at the statistics of the process, that's how it should look. But given all that, the simple and intuitive answer is like miles per gallon. You're putting in 1 unit of risk into this trading process. How much money is coming out at the other end? What's the conversion from risk to return? And that's the return efficiency.
Does it surprise you after all these decades of varying trend following performance, quite a few practitioners, does it surprise you that in 2012 and as we enter 2013, that you have to spend, not that it's necessarily a bad thing, I'm sure you enjoy it, it's all part of the process of life and making things happen, but that you spend as much time as you do still attempting to educate those that might allocate money to a trend following trader about how to think about what this strategy is in comparison to other strategies and how they like to judge other strategies. It just seems like, and you're not the only one to deal with this, that it seems like there is still it's very difficult for a good portion of the finance community to still wrap their arms around what you do for a living.
I jokingly call it what I call the black box disease. I do a lot of marketing for my firm. I've met people whose net worth is more than hundreds of millions of dollars. And I met individuals, I met banks, and whatnot. And it all boils down to one thing. I can't invest in something I don't understand. It's a black box. And that's what I call the black box disease. It's a black box. I can't understand it, so I can't invest in it. But really, think of it another way. Do you understand every single pattern that covers the engine of your BMW, but you're happy to drive the BMW? You don't have to build a car in order to drive it. And if you want to mow your lawn, do you need to understand how the lawnmower is built in order to go use it? The answer is no. And my view is that what we have done as a firm, or others have done in their firms, is created a machinery for harvesting trends or for, making money from trends. And it's just a machine. And you don't have to know every single thing about the machine in order to use it. And, you're putting gas into your lawnmower, you're putting a certain amount of risk into the trading program, and you can see how well it mows a lawn. You can see how much return you're producing. There's a return efficiency, miles per gallon. And, ultimately, that is part of the push for creating something like the Rho Trend Barometer, because people said, well, okay, I know what you guys have done, but what would the rest of the world have done? And how do I know that you're any better or worse than someone else? And so the Rho Trend Barometer, in a way, gives you an unbiased benchmark where you know what's in it, you know what the portfolio weights are, unlike an index. And it's pure trend following, because indexes have, many, many managers with all different strategies. You don't know how much of it is trend following, how much it is not, and so on. So, yes, it is a bit of a struggle, but as I say, it's a machinery, just use it. And in order to use a machine, you don't necessarily have to know every single thing about how the machine was conceived or built.
I'm gonna jump around on you. You can handle it. You're good at it. But one of the things that I saw in some of your points that kind of we were kind of exchanging some notes before we talked today. And one of the things that caught my eye was something that I see a lot. And I'm always careful before I say something, because I know quite a few people in the industry and I respect a lot of people. And there are different views on this subject. And your line caught my eye really quick when it said, are 100 PhDs better than one? That caught my eye, because there are quite a few. I will occasionally hear from people that maybe they're an individual trader and they want to branch out and learn and try trend following trading. And they say, well, why should I do this? There are firms out there that have hundreds of PhDs, and how can I compete with that? And I always just think to myself, like, even if you don't know anything about trend following and you're brand new, but if you grasp the basic idea of having a system and having a system put in place, and trusting your system, how could 100 PhDs necessarily help that system? I mean, are they changing it every day? It just on a basic level, it doesn't really. I think there's reasons for why firms, marketing is one, and there's data issues. But why don't you speak to the idea of the PhD, the land of PhDs and the land of marketing in the trend following space? And you have a PhD, right?
Oh, yes, I have a PhD myself. So, this is a question. Well, first of all, you raised very interesting. I have a PhD in engineering, and I'm proud of it. I worked hard for it. Now I'm applying the skills I learned. When I did my PhD, I learned how to learn. That's kind of the simplest way to think about it. And now I'm just applying how I learned how to learn to trading versus doing something else. And certainly a lot of the really big firms, really big CTAs are marketing to institutions, who are pension funds and so forth. So there's a lot of window dressing that goes on. I mean, I don't want to, underestimate the value of what a lot of PhDs can do. But if you compare our performance to the performance, the biggest and brightest in the business, it's just as good. In some ways it's better, some ways it's worse, but we've competed very effectively. So to get back to where we started, 100 PhDs is better than one. I mean, we always ask the question, okay, you've seen our performance, you've seen their performance. Is their performance 100 times better than ours because they've got 100 PhDs? And the answer is no. But, so even if you don't have a PhD, you're just starting off as a trend follower, you have some big shoes to fill, because the fundamental problem is that you have to trust your system, which is the words you used. And it takes a long time to trust your system, because trusting your system means trusting yourself. And are you willing to trust yourself? Are you willing to be systematic? Are you willing to follow the ups and downs in the markets, take the hits and so forth, which lo and behold takes us back to the Rho trend barometer, because now you have a trend barometer. You can look at what is the world doing, what's happening to the environment. I understand the environment. I have a context. Within this context, how's my performance? Can I trust my performance? Can I trust my system? So you're asking for people to do big things, to go against cognitive biases, which is something else we can discuss, what I call top scholar. Because when you think of cognitive biases, the way the human brain is wired, for equal gains or losses, gains give us less, or in terms of pleasure or pain, than losses. Losses typically produce 2.5 times more pain. So if you have some units of pleasure or displeasure, $1,000 profit might give you 22 units of pleasure, and $1,000 loss might give you 77 units of displeasure. So the human psychology is not geared for systematic trading. And so, again, I think that if you're an individual just starting off, you can be a systematic trader just as easily as anyone else. But you need some reference, so you can use the Rho trend barometer. You need to trust yourself. You need to trust your system. And, you got to be patient. And, there are lots of human nature will not allow you to be a systematic trader. So you got to work hard at it.
Well, let me dig in a little bit there. So you're not the first trend following trader I've talked to that wears their trend following label as a scarlet letter. For whatever reason, I find trend following traders very honest. They lay it all out there, the good, the bad, and the ugly. And it ends up being, in my mind, sometimes, and perhaps this is due to regulation, that I find trend following traders are so used to putting all the negatives out there. I think sometimes I wonder, hold on, where are the positives? where are the positives? So I think when you say that trend following goes against, or systematic trading goes against human nature, in many ways, couldn't you turn around and argue as well that the basic way that most people make their allocations in the typical way in the last 20, 30 years, the mutual fund thought process, the 60-40 stock bonds. And then they take those strategies, they apply it to their net worth. And then basically every 5 or 6 years, maybe every decade, they have a 50% drawdown because the buy and hold process melts down. I don't think that's easy to accept either.
Yeah, but there's been many years of careful massaging and messaging to convince you that it's okay to do that. I mean, it's a marketing game, and the mutual funds and academics have done a great job saying that no, don't do market timing, buy and hold, buy and hold, buy and hold, because, gee, that's perfect. If you're a mutual fund guy, you got lots of assets coming in, you want people to buy and hold so you can collect fees. So there's a conflict of interest in proposing that that's the only strategy for an individual investor. And also you have to remember, if you look at the performance of the U.S. stock market and compare it to other markets around the world, the U.S. market has been unique in that it has gone up almost without let up for 100 years. But if you look at the performance over the last 15 or 20 years, it's been a lot less glamorous. And if you've been listening to the pronouncements of all the sages, they're saying, well, we're not going to get 8% a year, you got to be prepared for less, and so on and so on. So what you have to think about is this, that if you are owning a mutual fund or if you own stocks, that's a long-only strategy. So a long-only strategy by definition will not make money when the trend is moving against you. If you're a CTA, we diversify your portfolio because we are not a long-only strategy. Number one. Number two, our speed of response is much, much greater than the speed of response of the average, by the buy hold. By definition, buy and hold, the speed of response is zero. Whatever happens, just hold on for dear life. And whereas we are reacting a lot faster than that. So if you think of a rolling 6-month window, our performance as an industry, as CTAs, has a negative correlation to the performance in stocks and bonds in general. What does that mean? If stocks are down over some 6-month horizon, typically we will be up over a 6-month horizon. So I understand where you need to have an equity position and you have, in your retirement packages, various things. But as a diversifying source, it's very, very difficult to find something better than commodity trading advisors. And if you look at the industry performance, forget what we have done and it's irrelevant. Think of the industry performance of trend followers. During massive sell-offs in the equity markets, it's been stellar. It's fantastic. So we are designed to give you tremendous diversification. And why are we good at it? Because we are systematic. We don't have an opinion. I'll give you a great example. I met some guy in a bank, many millions of dollars under management, discretionary trader. It says, I want a systematic trader to offset my discretion. Last year, I thought bonds were a bad place to be, so I had 0 bonds and I shorted them. I lost money. But the systematic portion, they didn't have an opinion. They were long bonds and made money. So as an allocator, as an individual, when you say that you want to be buy and hold, that's a discretionary position, long only strategy, one strategy only. We as a systematic trader don't have an opinion. We're going to diversify you way better, much, much more consistently. But of course, we need trends to be successful. And that's where, we're back to the trend barometer. So it's not that we cannot make money, but we need trends. The train has to be moving for us to make progress from one station to another.
Let me let you run with it, because as we're talking about that, one of the other benefits that I see with trend following are the outlier events, the things that are very difficult to or impossible to predict.
Correct.
And I was about to say very, very difficult to predict. It's impossible to predict. So where can you give a good explanation to the person that's sitting out there, whether it's the high net worth individual, it's the retail investor, it's the pension fund manager, to let them wrap their arms around the idea of why a trend trading, a trend following strategy, a quant strategy like you employ, some of the things that are covered in my books, why that often performs exceptionally well during surprise time periods. Let someone wrap their arms around why the surprises and the crises and the unforeseen outlier events often benefit trend following traders.
Okay. The idea is that number one is because we don't have an opinion. And number two, because we are systematic. And number three, because we're not very smart. Let's be simple. Let me explain that. First of all, we don't have an opinion. So, we're not going to say that, oh, we're not going to put on this position because I'm convinced that it's not going to happen. It's, my conviction has nothing to do whether I put on a trend following position or not. So that's number one. Number two, we have a systematic process, which means we let our profits run and cut off our losses early. This is exactly the opposite of the discretion trader. We talked about the stop school idea, the cognitive bias problem. For the typical investor, they'll cut off their profits early because they're afraid it's going to become a loss. And then they're going to hold on to a losing position because they think, oh, it'll recover. So this is the opposite of what we do as systematic managers. We cut off our losses early and we let profits run. And that's what I mean by not being very smart or opinionated. Because if the market is trending, we're going to be in there for however long it trends. We're not going to get ahead of the trend and get out of the position. So for example, if you think of Swiss franc, we hear the short-term trading and, there's all this counter-trend trading and, this is the end of trends. Look at the Swiss franc over the last, say, year and a half. We had the most amazing trend that went from zero to infinity practically, despite of all the short-term trading and all the counter-trend trading and all the institutions shorting it all the way up. Now, if you are a discretionary manager, you would have had 1,000 reasons to get off during all the way up. As a systematic manager, we didn't have an opinion. We were just holding on to a position. We're being, quote, not very smart and just hanging on for dear life. We made a lot of money. And in fact, in our case, we got out one day after the absolute high of the move. So we got out at a point that most discretionary managers would never have reached. And why did we get there? Because we didn't have an opinion. We were not very smart. We just said, oh, we're going to put on our blinkers and follow our trends. So the reason that we as trend followers make money is because every now and then the trend is going to go much farther than you'd ever imagined. And we're not going to be so smart that we're going to get out of the trend before it ends. And so we are going to have a few outliers, meaning if you think of a normal distribution, it says that you cannot have numbers very far away from the mean. So if you think of standard deviation as a unit of measure, then you're not going to get points, say 3 or 4 standard deviations away from the mean. That's sort of the idea. But because everybody's human and we have crises like Lehman Brothers, you're going to get returns that are very, very far away from the mean. And you're only going to capture them if you are, number one, have a position, meaning you don't have an opinion. And number two, you hang on to that position, meaning you're not so smart that you're going to outsmart yourself and get out too early. So that's why trend following works. Because A, we are systematic and disciplined. B, we don't have an opinion. And C, we're not too smart. We're just hanging in there and, we're going to follow the trend wherever it goes. And then we're back to the trend barometer because that tells you, which sectors or which markets are having extraordinary moves.
Tushar, as we wrap up this morning, let me ask, or let me give you the floor, so to speak. Are there any issues that you might want to address as we close up this morning that I haven't brought up? Anything that's near and dear to you that you might want to discuss?
I'll just mention 2 things, and you can go to our website and learn more about it. First thing, what I call the offense-defense ratio, which is a way to get an idea about how good your system design is or systems are. So this offense-defense ratio is a measure of the average winning month divided by the average losing month. And the higher the ratio, the better off you are. And for a good CTAs, there's typically numbers between, say, 1 and 2. It's hard to find numbers much greater than 2. So that's one statistic that we like to use. And then the other thing I like to point out is that when you think of correlations, the tendency is to only look at 1 month of data, monthly data, and only look at overall correlation. But I think you need to separate things into correlation during up months and correlation during down months. And you also need to look at rolling longer intervals than 1 month, like rolling 6-month intervals, so that you need to understand how a particular model or system adds value on the upside and the downside, as well as over a longer time horizon.
Best place. Now, I want people to grab your books too. I mean, obviously, your books are on Amazon, Beyond Technical Analysis and New Technical Trader with Stanley Kroll. And the best place for people to reach you, Tushar?
They can just go to our website at Rho Asset Management, roam.ch. That's Romeo, Hotel, Alpha, Oscar, Alpha Mike.ch, and there'll be a way to contact me over there.
Okay. And now are you still writing some for technical analysis of stocks, commodities?
No, not any longer. Yeah. I'm really no longer a contributing editor there. I haven't been for a while. Primarily because once you get into this whole money management business, there are a lot of constraints on what you can say and how you can say it. So just easier not to, write actively all the time.
Yes, I like my freedom.
Oh, yeah. Well, you have an advantage.
Well, listen, hey, it was good chatting with you, and have a good holiday, and hopefully we can catch up in the new year.
Well, thank you very much. Thanks for having us, and I hope we've added something to the dialogue, and have a great sort of holiday and a happy new year to all of your listeners.
Absolutely. Thank you.
Thank you. Have a great day.
You too.
Bye.
Bye-bye.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.